Group statements, value adjustments. The effect of value adjustments on group statements, and specifically where we deal with depreciable property, plant, and equipment. Example C. At acquisition date 1 January 2010, the identifiable assets and liabilities of S Limited, the subsidiary, were considered to be fairly valued in terms of IFRS 3 business combinations, except for the equipment. The carrying amount of the equipment in the trial balance of S Limited on this date is 480,000. The fair value is, however, 520,000 Rand. The remaining useful life of the equipment on 1 January 2010 is 10 years. S Limited accounts for the equipment in terms of the revaluation model of IAS 16 property, plant, and equipment. On 1 January 2013, S revalued the equipment for the first time to a net replacement cost of 400,000 Rand. Any revaluation surplus realizes when the equipment is sold. The financial reporting date is 31 December, and we're going to consolidate 31 December 2013. At acquisition date, a value adjustment is required on the equipment from 480,000 in the separate financial statements of S to 520,000 in the group statements. The additional information in this example tells you that S only revalued this equipment for the first time on 1 January X13. So, while S accounts for this equipment in terms of the revaluation model, we can gather from the information that S did not account for this value adjustment on acquisition date. So because S did not account for this valuation adjustment at acquisition date, there will be differences that we need to identify. How do we identify the differences? We compare what's recognized in S to what we want to be recognized in the group statements. Whenever we identify differences, we know it will lead to consolidation journal entries. This calculation is performed from acquisition date. On this date, the carrying amount of the equipment was 480,000 in S, and the fair value is 520,000. That resulted in a revaluation surplus value adjustment at acquisition date of 40,000 Rand. Since acquisition date, further differences were identified. For X10, X11, and X12, which is the previous 3 financial years, we identified differences in the depreciation recognized in S and the depreciation that we want to be recognized in the group. S recognized depreciation of 48,000 in the group. Because we have an increased carrying amount, the depreciation should have been 52,000 for 3 years, leading to an annual adjustment of 4,000 Rand. On 1 January X13, the carrying amount of this equipment in S is 336,000. In the group statements, the carrying amount will, however, be 364,000 Rand. On 1 January X13, S revalued this equipment to a net replacement cost of 400,000, resulting in a revaluation surplus through OCI. It's a current year revaluation in X13 of 64,000 Rand credit. Because the carrying amount is different in the group statements will only have to recognize a revaluation surplus through OCI credit of 36,000 Rand. That leads to a further difference of 28,000 relating to the X13 financial year. All differences needs to be adjusted for through consolidation journal entries. Because S did not account for this revaluation at acquisition date, the first entry to record is a credit to the revaluation surplus equity item at acquisition of the subsidiary, 40,000 Rand. That increases the at acquisition equity of the subsidiary every year so that it is available to eliminate in your at acquisition elimination journal. The question to ask is, what is now the other items in S that's different from what I wanted to be in the group statements? Very important to note in this example, you cannot adjust the equipment of S. The equipment in S's separate financial statements has been revalued to a net replacement cost of 400,000. That is now the correct value for both S's separate financial statements and the group financial statements. There's no longer any differences relating to the carrying amount of the equipment. So none of the consolidation journal entries at this point in time should change the carrying amount of the equipment. The items in S that do need adjustment are retained earnings opening balance for the previous 3 years additional depreciation of 4,000 Rand each. The question is now, where do we take the adjustment for the 28,000 OCI adjustment in the current period? S accounted for a 64,000 credit in his separate financial statements through OCI, where in the group financial statements it should only be a credit of 36,000. How do you change a 64 credit to be a 36,000 credit? With a debit to revaluation surplus through OCI of S, 28,000 Rand. We have now written consolidation journals for all differences identified. How would this journal change in the X14 financial year? Again, you start off with your revaluation surplus at credit of 40,000. Then you ask again, what is the other items in S that's different from what I want it to be? Again, the retained earnings opening balance for the X10, X11, and X12 additional depreciation of 4,000 Rand each. And now you cannot have a debit to revaluation surplus through OCI anymore, but a debit to revaluation surplus opening balance of S. In X14, it is the revaluation surplus opening balance of the subsidiary that is too high for purposes of the group financial statements. So your debit goes to revaluation surplus, opening balance 28,000. This journal would then be the journal that you would process for all years in future.